How to get ready for making tax digital for income tax. If you are a sole trader or landlord without an accountant or bookkeeper. So, what is a self-assessment? Self-assessment is how HMRC collects income tax from individuals who do not pay tax as an employee. If you're any of the following, you may be required to fill out a self-assessment tax return each year. Self-employed or sole trader. Receive rental income. A company director. Receive investment or dividend income. Earn over £100,000 per year. Have foreign income. Can I do my self-assessment myself? Yes. Legally, you don't need an accountant. Many people choose to complete their own self-assessment each year, in particular, if their income and expenditure is simple. According to the gov.uk, last tax year, HMRC received almost 12 million of tax returns and 40% of these were filed without an agent or accountant. What is making tax digital for income tax? Understanding the rules. From the 6th of April, 2026, some sole traders and landlords registered for self-assessment must use it, based on their total annual gross income or turnover from self-employments and properties. If this applies to you, then you will need to use compatible software to create, store and correct digital records of your business income and expenses. Send your quarterly updates to HMRC. Make any required adjustments to your self-employment and property income and expenses. Complete and submit your tax return by the 31st of January the following year. MTD introduces fairer, more proportionate penalties for late submissions and late payments. Customers joining Making Tax Digital in April 2026 will not receive penalty points for late submission of their first 4 quarterly updates. This easement does not apply to the end of the year tax return 2026-27, due the 31st of January 2028. For their first year, customers will have an additional 15 days. Giving 30 days in total to pay any outstanding tax before a late payment penalty is issued. There are no changes to the way tax is paid and the dates payments are due. When does MTD become a legal requirement? When you're an individual registered for self-assessment, and your qualifying income is more than the threshold, and you get income from self-employment or property or both, and when you have made 1 or more self-assessment tax returns. The income threshold depends on the date. From the 6th of April, 2026, the threshold is over £50,000, which is the qualifying income in 2025-26. From the 6th of April, 2027, the threshold is over £30,000, which is the qualifying income in 2026-27. From the 6th of April, 2028, the threshold is over £20,000, which is qualifying income in 2027-28. What is qualifying income? Your qualifying income is the total gross income that you get in a tax year from self-employment and property. All other sources of income reported through self-assessment do not count towards your qualifying income, such as income from employment, pay, your share of profit from a partnership as an individual partner, dividends, including those from your own company, estate pension, private pensions. Please note, your total gross income is your total turnover before your expenses are deducted. How HMRC will assess your qualifying income? To assess your qualifying income for a tax year, HMRC will look at the self-assessment tax return that you submitted in the previous tax year. If your qualifying income in the previous tax year was more than £50,000, then HMRC should have sent you a letter informing you are required to use MTD from the 6th of April, 2026. Please note, if you did not receive a letter but you made the criteria for MTD, then it is your responsibility to check and sign up to use MTD. If you complete the SA 103F, your self-employment income comes from boxes 9 and 10. If you complete the SA 103S, Your self-employment income comes from boxes 15 and 16. The qualifying income for UK property comes from boxes 5, 20, 22, and 23 of the SA 105. The qualifying income for foreign property comes from boxes 14 and 16 of the SA 106 pages. There are two types of exemptions. Automatic exemptions. Based on information already held by HMRC, for example, you're not required to use MTD for income tax because your qualifying income is below the threshold or you are submitting a tax return as a trustee. Exemption requires an application to be made to HMRC, for example, when it is not reasonable for you to use compatible software to comply with MTD for income tax. You can find out if you can get an exemption at www.gov.uk/guidance/ Find out if you can get an exemption from making tax digital for income tax. Prepare for MTD. What you need to do. You will need to use a compatible software to keep digital records, submit quarterly updates, carry out end-of-year actions, and submit the tax return. Digital record keeping. At a minimum, the digital record should consist of date, amount, and category. You need to create and keep digital records of your self-employment and property income and use Making Tax Digital for income tax compatible software to create the summary totals of income and expenses by category and submit these as a quarterly update. If you have more than one business, you need to fill in separate tax return for each business. For example, if you are a plumber as well as a driving instructor, you should create one set of digital records for each of your businesses. You can choose to categorize your expenses in less details, which is the consolidated expenses, if either your total UK property income is less than £90,000, which is the VAT registration threshold, before expenses. Total income from self-employment is less than £90,000 before expenses. In the consolidated expenses you must, if you are a sole trader, you only need to record whether a transaction is an income or an expense. If you are landlord, you must record whether a transaction is an income or an expense, and if it is an expense, whether it is for residential finance costs. If you make a mistake when creating a digital record or you forgot to record an expense or an income you received, you can correct the mistake and send it to the next quarterly update. You can choose to keep a digital record of the disallowable portion of an expense in your software. For example, you have a mobile phone bill which totals £200. The bill is made up of £125 business calls and £75 personal calls. Then, you should create a digital record of the full £200 expenses and the £75 disallowable portion. Quarterly updates. Quarterly updates are unadjusted summaries of categorized income and expenses submitted each quarter to HMRC. Using Making Tax Digital for income tax compatible software. They are not tax returns. You are not required to make any accounting or tax adjustments before sending an update. There is no payment required after a quarterly update. The update must be sent for each trade. So, it could be one update for self-employment business and one for property. Every 3 months, MTD for income tax software will total the digital records and produce summaries for each income and expenses category. You'll submit these from the software each quarter. Quarterly update periods and deadlines. There are two types of update periods: standard update periods and calendar update periods. In both cases, the deadlines are the same and your tax return is still due on 31st of January after the end of tax year. There is no change to payments on account dates. Submit your tax return. By the 31st of January following the end of each tax year, you are required to submit your tax return using MTD-compatible software. Before you submit your return, you can adjust the data you have sent before you finalize your income tax position and submit your tax return by making adjustments such as removing disallowable expenses, making accounting adjustments, Adjusting your income and expenses if you use an accounting period that is not aligned to the tax year and claiming reliefs and allowances. Once you have made all the adjustments, you need to make sure all other source of taxable incomes or gains are included in the MTD-compatible software. These are added by you or HMRC, and you need to make sure this information is correct. If HMRC already has information about your income or gains, then is added into your tax return. This includes pay income, student loan repayments, income from state, private and occupational pensions, construction industry scheme, subcontractor deductions, capital gains tax, residential property disposals, marriage allowance claims, and voluntary Class 2 national insurance contributions. Once you have made all the adjustments to your self-employment and property income and expenses, added all your income sources and gains that aren't already pre-populated by HMRC, and checked all the information is correct, then, through a MTD-compatible software, trigger a final calculation. Check the calculation is correct, and submit your tax return by declaring that your information and calculation is correct. Prepare for MTD software. You need to use MTD for income tax compatible software for creating, storing, and correcting digital records of your business income and expenses, sending quarterly updates to HMRC, receiving information, such as your tax estimates, from HMRC, and submitting your tax return to HMRC. You can have one software for doing the above tasks or multiple digitally linked software products. For example, you can create digital records in a spreadsheet or a software product and transfer them into another software, called bridging software, which then sends the quarterly updates and/or submit your tax return. The transfer between two products must be done using a digital link, which means you cannot manually copy and paste or retype the total figures from one product into another.